Hi everybody, Chris Wittich here, tax partner with Boy and Berenshire. I wanted to dive into the CARES Act and some of the business tax provisions that were part of this bill, which it passed the Senate, is about to pass the House, and should be signed into law, I don't know, maybe tomorrow. So let's talk about some of the business tax provisions and see how they might impact business owners. One of the things that's happening as part of this is 163J, which was limiting the interest expense that some businesses could claim. That was relaxed for 2019 and 2020. But that affected businesses that were larger than 25 million in gross receipts. So that's a little bit of welcome news for those people who were potentially being limited by this new law about interest expense limitations. The other big thing that I think is going to apply to tons and tons of businesses, and is potentially one of the largest things in this whole bill, is what they're calling they've called it a number of things, but a retail glitch or a qualified improvement property glitch. Basically, when they wrote the tax bill 2.5 years ago now, they changed the definition of qualified improvement property. So that's the leasehold improvements, the retail space build out, restaurant property build out. So those types of costs, they got lumped together into one category called qualified improvement property, so QIP. And they clearly intended for this property to have a 15-year life. But they messed up the bill and they wrote it wrong. And so it had a 39-year life. So that means for businesses, if it has a 15-year life, you were going to get 100% bonus depreciation on it if you wanted. And if you elected out of it, you would have sort of a straight line over a 15-year period, which was going to be great. I mean, most people would take the bonus depreciation 100% the first year, but at a minimum, you would get it over the 15-year period. But they messed up the bill, and so everybody ended up with this 39-year life and straight line depreciation, and it was really detrimental to some of the planning for business taxpayers. So they've gone about fixing that as part of this CARES Act, and they've fixed the glitch. And so they're changing the definition to be exactly what it should have been, which is that this qualified improvement property now gets a 15-year life. So what does that mean if you already filed your return in 2018, or you already filed your 2019 business return, and you were unable to take advantage of those rules, and you marked it all down as 39-year straight line property? Well, now that they've changed the definition and the way that they've changed it, it is retroactive. So this will now apply to 2018 and 2019 tax returns, which means you can go back and amend. So you can go back and amend your 2018 or your 2019 return if you've already filed it, and change the life of these qualified improvement property to be 15-year, and it will then automatically take the bonus depreciation. So you're going to get 100% write-off on this stuff, but you're going to need to file an amended return to do it, which is fantastic news. This was a mistake that Congress made in sort of the haste of how they wrote the bill. So it's great that they've finally corrected it. One other aspect for business taxpayers or people with business income, flow through business income, is that they've changed the net operating loss rules, and they've made them much more favorable. So now that you can get a 5-year carryback on 2018, 2019, and 2020 losses. So let's just think about a scenario here where a business had a large amount of qualified improvement property in 2018, and they thought, oh, good, we're going to get to write off 100% of it. And then they never fixed the law, and you maybe had a bunch of income in 2018 because you were not able to write off your improvements that you thought you were going to be able to. Well, now you can go back and file an amended return for 2018, and you're going to change that into 100% bonus depreciation, which could create a very large loss. But they've also liberalized these NOL rules. And so now if you have a big loss in your 18 year, either for a C Corp or for a flow-through entity, that individual taxpayer or the C Corp can take the loss that was created on the amended return and then carry it back 5 years and get a refund. So it's really a tremendous, tremendous opportunity for clients that had that qualified improvement property to look at amending their 2018 or 2019 returns if they're already filed to potentially either just save taxes based on the change or save taxes, and if you create a loss, then you can carry that loss back and get another refund on the loss carryback. So some tremendously good news for businesses, especially those who have this qualified improvement property. You should really seriously be looking at, should we be filing amended returns for 2018, 2019, and just how does all that look with the new net operating loss rules? So some great changes. This qualified improvement property fix, we've been waiting on it for 2 years now, and we finally got it. So it's really important to go back and look at these situations and see if there's a potential there to get a big refund, because that's really the point of these rules, is to get cash back in the hands of taxpayers. You just got to understand what they are and how they apply to your situation so that you can carry it through and get that refund to hopefully help assist your business in these obviously unusual set of circumstances. So I don't know, that's all for now. There's certainly more in the bill which we'll be diving into, and you'll see there are lots of other posts on the website now trying to dive into some of the other provisions. Many affect either businesses or individuals, but for now those are the big tax items, and I'll talk to you later. Thanks.